Next up, we have Shae Russell. Now, Shae Russell is well known by a number of you that are watching today. She is the chief editor of the Daily Reckoning Australia. She's also with Fat Tail Media and has Rockstock Insider, amongst many other things. She's well known to a lot of us in the gold industry. Shae, thank you so much for coming to talk with us today about digging to Hades, how the big dig will change Australia's gold mining future. I'm really looking forward to this. And ladies and gentlemen, get your pen and paper out. There's going to be lots of little gold nuggets in this one.
Kerry, thank you very much for having me. I'm absolutely thrilled to be here. Wish I was there with you in person, but don't worry, I reckon we'll be able to pull it off next year. Now, before I kickstart today's presentation, we're going to go a few things before I get to the why I think the best days are ahead for Aussie gold miners. And we're going to kick off with my headline, which says, Digging to Hades. Now, I need to make it very clear, I did not come up with this headline. I have completely borrowed it from Rick Rule. It came from an interview he and I did in April last year. And I threw out a line to him. I said, what do you think the prospects are for Australia's gold mining future? And he laughed and he made a joke about how you'll be digging to Hades down here. So I've done a little bit of grunt work and I'm going to show you why he said that. First and foremost, before we do anything, we just need to go over the risk slide. Basically, this slide simply tells you is that if you're not into risk, my presentation might not be for you. All right, now for those of you who don't know me, I'm going to introduce myself a little bit. As Kerry pointed out, I run a couple of subscription newsletters. First of all, I'm the chief editor of the Daily Reckoning Australia, which is basically where I take global macro trends and sort of drill down on what they mean for ordinary Australians. Then there's my entry-level service, which is Rockstock Insider. And that's pretty much all about gold, what the role of gold, why it's important. But I don't just do this by, telling you to take my point of view. I interview experts from all around the world. Both Kerry and Egon have made appearances in my newsletter. Then there's Hard Money Trader. Now, this is a premium service and it's also a very speculative service. The sort of stocks I'm recommending here are actually tiny, tiny micro gold explorers listed on the ASX. Now, I'm at risk of overusing this joke, but the sort of stocks I look for here are not much more than a bloke and a shovel. And I say that just to try and emphasize how risky these stocks are. Personally, a little bit about me. Now, Jim Rickards and I are in this photo playing pool together. It all began in 2015 when we met each other for the first time at a Jim Rickards conference. And since that day, we have had a very heated pool competition. I've been his Australian editor on numerous publications here. But more importantly, I'm a bourbon drinker. My favourite tipple of choice is Maker's Mark. And also, too, I'm a four-wheel drive enthusiast. I can think of absolutely nothing better to do on my free time, which is racking off to the bush in my bright yellow FJ Cruiser. All right, before we get into what's happening in the gold mining sector specifically, I want to talk a little bit about my gold windows theory. And there's a reason why, so just humour me a bit. Now, I know gold recently hit all new highs in US dollar terms. It's hit $2,000 per ounce, but there has been a pullback. But I want to show you what this pullback means in a historical context. Now, based on the two previous gold bull markets, I've identified 3 phases that gold moves through. And I'm showing you this today to show you why I believe that there's better days ahead for gold. All right, so first of all, this is the gold window from 1971 to 1979. Or actually, I think the chart goes out to about 1980. I've been caught out there. So first of all, you can see here I've divided it into 3 neat sections: currency devaluation, investors, and then the mania phase. Now, currency devaluation is simply just a reflection of how the US dollar was declining while the price of gold was rising. Now, the investor phase is simply identified by retail investors being able to access the metal, essentially interest moving into gold. Now, in the case of the 1970s, it was actually the creation of Wall Street futures on gold that enabled more people to trade the gold price. And of course, the mania phase probably doesn't need a lot of explanation, but it's simply put, this is the price, this is the point where gold seems to, rally higher and higher and higher with no end in sight. There was a similar pattern that evolved, that revealed itself back in 2001 and 2011. The currency devaluation phase played out over a few years from 2001 to 2004. Now, the investor phase was slightly different this time around. This is where we saw ETFs driving the investor phase of the gold window. So, gold-backed ETFs weren't really a thing until 2003. but it was gold under management around this time that increased quite significantly. And I've got another chart to show you later on just how the volumes of gold under management increased. So this is the investor phase. This is where gold was only rising a few $100s over a few years. And then also too, again, we've got the mania phase, and you can just see how wild those price swings are. Now, obviously, looking back, it's easier to say where you should have bought in, but it's not always the case. And this is why I want to point this out today. Have you missed the gold bull market this time around? Absolutely not. We are just getting started. Gold has rallied in US dollar terms up over 95% when it hit those all new highs a couple of weeks ago. As I said, there's been a pullback, but this pullback is actually a really good opportunity for new investors to consider purchasing physical metals if they hadn't already. Furthermore, too, I actually think the pullback that we're seeing from the all-time highs is replicating those downward moves that we saw in the investor phases in the past two gold bull markets. Now, one of the reasons we know that the currency phase, the currency devaluation phase, is completely done with is because gold has hit all-time highs in almost every major currency around the world. Now, obviously, the Aussie dollar is not a major currency, but I've included it in this chart because we're Aussies. Basically, the British pound, the Japanese yen, the euro, they all hit all-time highs in the gold price as of last year. The Aussie dollar, same thing. Now, it's only been the US dollar and the Swiss franc that were lagging behind and not hitting all-time highs. However, with the recent gold price a couple of weeks ago cracking that all-time high, we can say for certain that the currency devaluation phase is completely over. And we're 100% in the investor phase of a gold bull market. Now, once again, we can tell this because of the amount of money flowing into gold-backed ETFs. Now, if you're I'll take your eyes to the middle of to the picture on the left. Around 2008, you can see this huge surge where gold, from 2004 to 2008, where there was an enormous increase in gold-backed ETFs. And that's basically tons under management. We are seeing the same unprecedented volume moving back in. Now, this has largely been driven by central banks. That was for the last couple of years, but this time around it's by gold-backed ETFs. But also too, I'd just like to point out, we're now looking at mainstream participation in gold. Almost every day for the past month, there has been at least one article on gold from well-read financial publications in Australia. And that just gives us a little bit of the indication that gold is becoming something that is worth talking about. And I want investors to just really take to really think about what that means. And if the mainstream's jumping on board, it means that it's catching their attention. So you haven't missed the gold bull market. A little quick takeaway before onto my next charts. Now, I stood up on stage last year and said this when somebody asked me a question of if I think it's even possible for gold to move to 10,000 US dollars like Jim Rickards has predicted. Back in 1971, there would have been nobody who said that gold was going to hit over $850 an ounce by 1980. And I will guarantee you again, in 2001, when gold was trading at 270 US dollars, there were very few people who said it was capable of hitting a price 7 times higher by 2011, yet it did. Gold tends to do unprecedented things, so don't rule out an extraordinary price move from here over the next at least 4 to 6 years. All right, now before we start talking stocks, I'm going to let you in on a little secret when it comes to my subscribers. And these, basically, if you want to be good at investing, the most important thing is you need to stay disciplined. First rule of thumb I love to live by is never invest in a company that can't explain what it does in 10 words or less. Another thing is invest in what you'll know. You'll be surprised how your own hobbies and your own career can influence your knowledge. And that way you can actually look for companies in that industry. But also to have an exit strategy. You're not investing in shares to hold them forever. The whole point is ideally making a profit and being able to sell them out eventually later on. So if you apply those 3 rules to your investment strategies, you'll actually find you become a better investor along the way. All right, time to talk about some of my favorite things now. And this is Aussie gold miners. I've got to say, Australia is in an enviable position right now, and I do hope some investors try and capitalize on that. Our mid-tier gold sector is remarkable. I've often made a joke that, you know, spin around and drop a pin on any of the top 10 majors and pick that one. Now, my compliance manager absolutely hates it when I say that, but I say that to emphasize the absolute quality of the mid-tier companies we're seeing right now. They are very well run. They are very cost efficient, and they're making money. Let's just take Evolution Mining, for example. I know they're speaking straight after me. Now, they are one of the lowest cost gold producers in the world. If you go over their recent financial results, you'll actually find out that their all-in sustaining cost is $1,043. Now, you'll see on the screen that I've put here that the top 10 gold miners by market cap average you know, are producing an all-in sustaining cost of $1,251. So Evolution Mining is obviously significantly below that. But on that too, when it comes to our Aussie gold miners, you really want to look for what they're selling gold at as well. A lot of them should be banking serious coin, because the Aussie dollar gold price is so much higher than the all-in sustaining cost. And just to flip back to the Evolution Mining example again, their non-hedged contracts, they had a realized gold price per ounce of over $2,300. So they're making almost more than $1,000 per ounce for every gold it takes them to get out of the ground. It's phenomenal, but it also gives you an idea. It really sets a standard of what you should be looking for when it comes to your gold miners. So essentially, if you are looking for mid-tier gold miners on the ASX, you want to look for companies that have got an all-in sustaining cost of no higher than $1,400. And I mean this when I say this, cashed up. A lot of our gold miners are so cashed up, it's embarrassing. It's also great because it does go to show you that they are making the most of their low-cost operations. Have a look at how many companies are hedging as well. Now, we are in one of the fortunate positions. A lot of our miners learned some ugly lessons from the 2000s, and that is to reduce hedging where possible. And good news is when you go through the financial data on a lot of our companies, you'll find that or the majority of them are actually not forward hedging too many contracts, which is fantastic news. Some don't even have any hedging in place. You want to see companies spending money on exploration or even growth. Basically, mining is a depleting asset. So you need to make sure that they are working hard on shoring up their long-term reserves. Where are their assets? Now, this sort of ties into sovereign risk. Now, Australia, Canada, North America, these are incredible jurisdictions to mine in. So generally, you don't have any worries. Some parts of Africa are quite mining friendly as well. But just remember, when you're looking at Aussie gold miners, you want to make sure that you limit your sovereign risk, or you're aware of how sovereign risk can increase or decrease your profits or losses quite substantially just because of the jurisdiction they're mining in. And obviously currency risk comes into play when your company you select is mining in a country other than Australia. All right, let's get down to the nuts and bolts. Simply put, gold is so much harder to find. The easy days of finding gold are pretty much gone. Not only that, it actually costs more to find less. So that is, the cost of discovery has been rapidly increasing. About 2 decades ago, you could, for each ounce found was about $10 to $20 per ounce. Today, it sits at around, the cost of discovery is around $60 per ounce in Australia. And Minex Consulting, I believe, have an estimate that that will increase by $10 per ounce going forward. Not only that, gold grades are falling. So not only are we finding less and it costs more, there is the quality of the gold in the ground is significantly decreasing. Now, that what we're seeing, one of the main trends in the gold sector, the gold sector at the moment, is that brownfields have been driving exploration growth. Now, brownfield explorations is essentially a fancy word for restarting old mines. Now, this is quite a successful gold strategy for many miners, simply because there's that old rule of thumb to go by. What's the best place to find gold? We've already found gold. So a lot of companies are looking at either expanding what they've got or looking at old historical companies and basically digging deeper or digging wider and seeing what can be found. However, one of the things, and this is a global trend, not so much an Australian trend, but there hasn't been a lot of spending money on greenfield projects. Now, one of the reasons why, or another word for greenfield projects is basically an area that's never been prospected before for gold. One of the reasons why is, this is back to the old joke of it's literally a bloke on a shovel. They are incredibly risky companies. So companies tend to not take on greenfield exploration projects because shareholders in the past haven't been a fan of it. However, I do believe that the higher the gold price rises, the more likely we are to see companies spending more money on greenfield projects. Now, I'm just bringing up a little bit of a visualization because saying gold grades are falling doesn't actually mean much unless you can see what I'm talking about. So I've got a chart here to put in historical context just how big or the slow long-term decline of gold grades falling all over the world. So this isn't just a trend that I'm talking about that's developed in the last couple of years. Gold grades have been significantly declining since the 1950s and the 1960s, which was arguably the heyday for discovery around the world. So this is affecting the USA, this is Canada, Australia, and South Africa. It goes some way to explain why it's costing so much more to shore up a deposit, because even when they do go looking for it, the quality of the gold is reducing. Now, furthermore, it sort of adds to the urgency of why spending on exploration and also too exploration stocks is so important. And this is that major discoveries are reducing at a very, very fast rate. So just take a look at the chart that I've got you here. You can see the exploration budget. And again, this is a global chart. The exploration budget is in yellow, and you can see that obviously that it peaked as the price went even higher in 2011, but then it dropped off. But as a result of the complete lack of spending on exploration, so did shoring up current reserves, and so did finding new discoveries. So it's really important that for shareholders, when it comes to looking at companies, that we do see companies investing heavily in exploration. Simply put, is because we are not shoring up gold deposits going forward. Now, this is just another chart that I wanted to show you to try and give you an example of what the global markets are doing. Now, as you can see here, gold financing has significantly reduced since 2010. And obviously what people are spending globally on exploration is also falling. Sometimes I find pictures help tell the story more than just my waffle. Now, I want to talk about tier one discoveries, partly because I believe we're fortunate to have De Grey Mining joining us today, and they could be on the cusp of something big, and we'll get to that more in a second. But basically, company making discoveries is anything over $6 million an ounce. And for lack of a better phrase, they're almost as rare as hen's teeth these days. Now, there's been an absolute drop-off in finding tier one discoveries, and that's got a lot to do with the lack of spending in exploration as well. But this also goes back to the fact that companies, it's harder to find. They've got to work harder to find. You know, we don't have x-rays to see what's under the ground. Companies have to sink a lot of holes in the ground to try and find what's there. So finding tier one company making deposits are becoming increasingly rare, but also too, they're very expensive to find. All right, time for a reality check. Now, it depends on who you talk to. So this chart here, this little picture that I managed to pull out, it says a 1 in 300 chance is a conversion rate from early stage explorer to a mining development. Now, I think it depends on who you speak to for what it actually is, because if you talk to a couple of people in North America, they think the odds are far more stacked against you, and that it's either a 1 in 1,000 or even a 1 in 3,000 chance of a discovery making it to a mineable deposit. So it is really, really important that if you are an investor, you look for a company that has a really good chance of not only finding something, but has the right team in place to try and progress this find into a mine, because the odds are absolutely not in shareholders' favors when it comes to getting a company up and out of the ground. Sorry, getting a mine up and out of the ground. Furthermore, now you'll just notice down in the bottom, it says that it takes roughly 12 years from discovery to production. Now that's today. About 15 years ago, it used to be 6 years from discovery to production. So the time from discovery to production it's basically doubled in a very short space of time. So investors need to be aware that even if a company has discovered something, it takes much longer to bring these mines up online. All right, let's look ahead for the Aussie gold mining sector. Now, for starters, I believe the pandemic is going to force countries and governments to become more mining friendly. What do I actually mean by that? I think we're going to see, especially in Australia, I think we're going to see governments become more flexible with land under tenure. Victoria is a great example of that right now. Victoria wasn't a particularly mining-friendly state for a long period of time, and it was the discovery of the Swan Zone at Fosterville that really changed the government's attitude to it. As a result, there was something like 80 applications for some of the new tenements that were put up last year. I think we're going to see more countries and governments want to work towards securing up their deposits in the ground, obviously too, because it means income for their people, but it also means income for the country. I believe we're going to see the reliance of human labour reduce. And again, this has largely been driven by the pandemic. Now, this was a trend that was well underway before the pandemic hit. We talk about the driverless trains and the drones working out in the Pilbara. But at the end of the day, human labour is unbelievably expensive in Australia. And also too, Australia is just lucky that they didn't get shut down by the COVID pandemic. Our miners were incredibly fortunate to be able to pretty much work through it. Now, higher prices are going to encourage greater exploration spending. Also too, low gold grades and gold projects become much more attractive at higher prices. Furthermore, higher gold prices create an incentive to spend more on greenfield projects. All right, now, I just wanted to point out here, this is really how Australia is leading the curve, is ahead of the curve when it comes to spending on gold exploration. As you can see, once again, there was a huge spend on exploration into 2011. Australia really began to increase their spending on exploration. About 2 years ago, we started to see that number track up, and that put a lot of our companies well ahead of the pack when it comes to spending on exploration, also trying to find up some bit more deposits. And this is just to break it down by deposit. So as you can see here, gold in yellow, this has come from our own RBA. We are spending more looking for gold than any other commodity Australia-wide. Now, given that we've done nothing better than ship iron ore to China for the past couple of decades, that gives you a leading indicator that even our companies are well aware of how quickly we need to shore up future deposits going forward. All right, digging deeper. Now, I did say before that Australia is vastly underexplored. Another way of saying that is we've been well prospected. So essentially, we've picked up all the easy surface gold. Now it's about finding out what's under the ground. The problem is finding out what's under the ground is ridiculously expensive. The average 1,000-metre drill hole costs about 100 grand. So not every company has that sort of money to do it, which means that we're going to need to find clever ways to find more gold for less cost, especially for our small juniors. And this is why technology is so important for future exploration. Many companies, many explorers, like N.I.T.R.I.C Minerals, for example, have partnered with the CSIRO to essentially come up with ways to track gold anomalies, but try to work out and do it faster. Basically, they're trying to look at, come up with better X-ray vision when it comes to looking under the ground. Now, I've got a joke there, move over Eastern Goldfields. I'm actually not trying to upset anybody in the Eastern Goldfields, but it's not the only highly prospective spot that Australia's got. And there's a couple that I'd like to draw your attention to. Now, I've been calling it the Victorian Gold Rush Renaissance to anyone will listen for the last 2 years. And it's not because I'm biased being based in Victoria. It's simply because I think there's so many opportunities here, but so many explorers and investors have stayed away from the sector, probably because it didn't get much love for the last few years. But basically, the discovery of the Swan Zone in Fosterville really did change the fortunes for Victoria. You've got N.I.T.R.I.C Minerals, who are doing incredible things out in the Stall Corridor. Then you've got Kalamazoo Resources, who have, they're looking at getting some, their early mineralisation is showing signs of looking like Fosterville. So much so that Eric Sprott and Nova Resources threw $8 million at them, which is no small, that's not chump change. Now, another area that I really think investors should be considering is the Pilbara. Geology, our understanding of geology has really changed what we know about this area. For a long time, the Pilbara, again, we didn't think it had much. Then Novo Resources and De Grey Mining, for example, have done incredible work out here to prove that not only does this area have traces of gold, that it could be an absolute game changer for Australia. It's early days yet, and I don't want to brag too much about it, but De Grey Mining, for example, could be on the cusp of a Tier 1 discovery. Now, if De Grey Mining actually unearth a Tier 1 discovery, that will be the first company making deposit at discovery since Tropicana was found in 2005. So if they pull it off, shareholders, I'm sure, will be very, very happy with it. But also, too, that's just trying to put into context how far and few between finding big companies are. Finding big deposits are. And finally, the Tanami Desert. Now, this area doesn't get a lot of love. There are some great big companies out here and a couple of international companies out here doing some incredible work. But I do encourage investors to look out here because there's a lot of money being spent in the area and it's definitely worth looking at. All right, so what is going to change the company change our future going forward? I'll be honest, I've said it repeatedly, technology when it comes to mining is the absolute wild card. So just indulge me with a little bit of a story. So panning for gold. We all know the panning for gold came out to Australia in Victoria in the 1850s. The panning for gold method introduced to the Victorian gold rush is actually based on a new technology in the Californian gold rush in the 1840s. And essentially what was developed out there changed how gold was found in Victoria in the 1850s. And that completely, I mean, yes, there were nuggets being pulled out of the ground, but basically it changed what we did with alluvial gold. Then also too, very few Australians know this, and I really want to draw this to your attention because it goes a long way to show how the smallest change in the industry can completely change a gold miner's economical fortunes. There's this thing called carbon in pulp processing, which didn't exist until the 1970s. Now, depending on which scientific report you read, it was either created in South Africa or created in the US. Now, carbon in pulp processing is basically adding activated carbons or oxygenated activated carbons into the cyanide mix. And what they do is they basically allow a company to extract more gold out of the ore. Now, this completely revolutionized the gold industry, and it's the reason why we have so many low-grade economical deposits out in the eastern goldfields. Boddington's a classic example of that. This was a mine that wasn't economical to the sheer size it is now. Carbon in pulp processing completely changed that. So this is what I mean by something that's 40 years old. Back then, it was revolutionary at the time. So I really think investors should keep it back in the mind when they're looking for companies, what tech adaptations are they applying to their exploration work and their mining processes? Because essentially, we can't, just because we can't see it today, doesn't mean that it's not possible in the future. A classic example I said before was human labor. Humans are expensive. It's also too dirty and dangerous work at times. So I can understand why mining companies would be keen to reduce their exposure to humans. Also too, by bringing more technology in, it allows more efficiencies. It reduces the error rate. And obviously too, it will go some way to reducing a mining cost. Well, I've nearly run out of time today. I'd just like to say thank you very much for watching. And Kerry, thank you so much for having me.
Shae, wow, I know in like 30 minutes to give all your knowledge is not a lot. Really can I just quickly, before we run out of time, we've got 20 seconds, a little bit longer. How can people get in touch with you if they would like to subscribe to your service?
Oh, look, you can come to the dailyreckoningaustralia.com.au. That's the best point to start there. And I can absolutely assure you my company will have ads on how you can get access to my my subscription services.
Shay Russell, thank you so much for joining us today. Full of great information as always. And next up, we will be, as you mentioned, talking to Evolution Mining. But thanks for joining us today, Shay.
Thanks for having me, Kerry.